Hi, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to our BCI podcast number 36. This one is titled Timing Our Covered Call Trades. The best time to sell options after buying the stock. Frequently over the years, I've been asked, why not buy a stock, wait a bit, see if the price goes up, and then sell the option? In all of my books and DVD programs, I recommend buying the stock and then selling the option immediately. So let's break this down and see the pros and cons of each approach. First of all, let's take a broad view of what covered call writing goals are, because basically we're looking at a conservative option selling strategy. Well, firstly, and most importantly, we're looking to generate monthly cash flow. Now, some people use weekly options, some use longer term. My sweet spot basically are monthly options. Either way, we're looking to generate income. We're also very concerned about capital preservation. Otherwise, we would select a different strategy. This covered call writing, as is selling cash secured puts, is a low risk strategy. That means that the returns we're going to get are not going to be through the roof type of returns, but they will be consistent returns. So we're going to select the best stocks, or it could be an exchange traded fund, and that will give us the best chance of succeeding from that first leg of the trade perspective. We're then going to select the best options, also looking to enhance the best chances for the highest returns. And with the option, that involves strike selection, in the money, at the money, out of the money, how far out of the money, how far in the money. These are the decisions we have to make. In addition to what expiration date of our contracts are we looking for? Once again, I have had my greatest and best results with monthly options. And then once we enter the trade, we have to know how to manage our positions, exit strategies. But what about the timing of our option sales? When is the best time to do that? And this podcast focuses precisely on that. Now, if we buy a stock and we wait to sell the option, there are three possible outcomes. First, the stock price can in fact go up, which is what we are hoping for if we use this approach to covered call writing. The stock price can go down, which certainly is not what we're hoping for. And of course, the price of the stock could stay pretty much the same. So let's break it down for each of these three possibilities. Let's start with the price of the stock moves higher. Well, that was the reason why we were delaying. We were hoping the price of the stock would go up. And if that happens and we decide to sell the same strike, we would get more money for it because the underlying stock is worth more. Or we can even sell a higher strike option, in which case we give ourselves a chance for greater share appreciation. Now, there are a couple of factors that are going against us, even if the price of the stock does in fact go higher. First of all, we have theta, or time value erosion. So for every calendar day that passes as we're waiting for share price to increase, the time value component of the premium will decrease. Now, theta is logarithmic in nature for near the money strikes, which means that it starts out decreasing our time value slowly, and as you wait longer and longer, it kind of increases dramatically. So we don't have too much time to work with here, waiting for the share price to increase. And then there's always the possibility, although less so than theta issue, is vega, or the decrease in implied volatility. There's always that possibility that the implied volatility of the stock or ETF can decrease, and even if the price goes up, it may not impact the premium that much. So we have those two factors working against us. Theta definitely, and vega possibly. But if we were to take a look at whether or not this strategy of waiting to sell the option is going to be successful, this is the category where it's most likely to be successful. stock price moves higher. Now, what if the stock price moves lower? Well, the strategy definitely fails. We're going to get a lower premium for the same strike. That's because of delta, the amount that the premium will go down for every dollar decline in the underlying security. And also, we have theta working against us, time value erosion. So we have those factors working against us. The premium will be lower. If the stock price moves lower, the strategy will fail. Plus, we may have to use a lower strike price to generate any meaningful returns, which will impact our chance of locking in share appreciation profit. So this is the opposite of the first possibility, where the stock price goes higher. If it goes lower, we lose. Now, the third possibility is the stock price remains about the same. Well, on the surface, it may seem like, well, no harm, no foul. But in fact, the strategy will fail. And the reason for that is, once again, theta rearing its ugly head. So if we could have sold the option on Monday, but instead sold it on Friday, we have lost 4 to 5 days of theta depreciation of the time value component of the option premium. So we definitely lose if the stock price stays the same. Once again, keep in mind that theta for near the money strikes is logarithmic in nature. So it starts off very slowly and then picks up steam as time marches on, and of course falls off a cliff as you approach expiration. So if we were to take an overview of this strategy, buying a stock and waiting to sell the covered call, we would say that it will work in perhaps one of the three conditions where the stock price accelerates in value. Theta is working against this approach. The more we wait, the more the time value component of the premium will erode because of theta. So, makes sense to buy the stock and immediately sell the option. This way, we're guaranteed our initial time value return goal. We have that all figured out before we sell the option. Will the sale of that option meet our system criteria, our stated initial time value return goal range? In my case, I look for 2 to 4% a month for near the money strikes. I'll go as high as 6% in very strong bull markets, but suffice, let's call it 2 to 4% a month. Now, once we enter the trade, we immediately put in a buy to close limit order to buy back that short call for 20% of the original premium sold. So if we sold a call for $2, we would put in a buy to close limit order to buy it back at 40 cents or lower, and then change it to 10% or 20 cents or lower halfway through the contract. That information on exit strategies is found in all my books and DVD programs on covered call writing. Now, let me just add one more component to this. The best time to enter our covered call trades is the Monday or Tuesday after expiration Friday, between the hours of 11 a.m. and 3 p.m. The reason I don't like to go very early or very late is because there's a lot of institutional computerized trading that kicks in during those hours, making those times much more volatile than the rest of the trading day. So I would rather work on my trade entries between those hours, 11 a.m. and 3 p.m. Eastern time. For those of you looking to calculate your covered call writing returns, we have a free Elman calculator located on our website, www.thebluecollarinvestor.com. Just look for the free resources link on the top black bar of all of our web pages. In the bluecollarinvestor.com store, we have a series of online video programs, ebooks, soft and hard-covered books, calculators, trade planners, coaching, online coaching information. There's so much educational products on our website. Have a look. There's also a ton of free resources on the general site. So, folks, that concludes BCI podcast number 36, titled Timing Our Covered Call Trades, the best time to sell our options after buying the stock. Ladies and gentlemen, I hope you enjoyed this podcast, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.